Introduction to Forex. This is our first module. There are a lot of slides. As I said, I will not go through every single of one of them. I will send you this document to you so that you can read by yourself. I'll just cover some of the stuff that I know today is important. This module introduction is basically we're talking about what is Forex, some terminologies which are important. And then also we will talk about some mindset that we need to have as a Forex trader. If you want to adopt Forex trading as your career or as your daily stuff, then you need to have a mindset, a winning mindset. And so that's why it's important. I will also talk about the mindset a bit. And then we will go into some technical details of the currency pairs and some of the terminologies that we use. And finally, I will touch about the technical analysis. We will not do technical analysis today. I'll just give you an introduction. And then in the next session, we will talk about technical analysis in more detail. We'll also see the difference between the traders, the winning traders and the losing traders. Quite important topic. So what's important? See, what is Forex? Forex is a market, is a currency exchange market, right? We actually use a broker who basically help us, in the transactions. So the broker effectively transacts the trade for you, right? And so basically you can buy currency and you can sell currency, right? And Forex is a central place of market. And it's actually conducted over the counter, which means you don't basically place orders and then wait for the results. It's immediate. You give cash. For example, you want to convert for USD to, let's say, Canadian dollars. You hand over to the counter USD and you get the Canadian dollars. And now we're actually talking about how we take the advantage of this market for our profit. So now currency market, unlike the stock market, Forex market, unlike stock market, is the biggest market in the world. It's actually the transactions per day happens 5 trillion transactions per day happen. So $5 trillion worth of market we're talking about. So there are plenty of opportunities for anybody to trade in. I'm also covering this Forex trading introduction, but when I actually teach you guys the more depth like analysis, I would probably not touch the Forex, but I will touch the different instruments, another instruments, which are more reliable and which doesn't have any dependency with the current situation of the economy. So that's what I kind of planning to do. So the qualities you will need to reach your goal as a Forex trader is some of these things quite important. One of the things that is very, very important for a Forex trader is patience. Because as you know, Rome cannot be built in a day. It is impossible for us to just go and start winning from the day one. It is nearly impossible. I don't think anybody has ever done it. The Forex market, you require practice and patience. So that's why there is a plan required. A trading plan is required. So you have to basically focus on plan. And the minute you have patience and then you have actually a plan, then you can actually become a stable earning Forex trader. And self-control, another thing is that when people start trading, they get a lot of money and they overtrade, and at the end they lose the money. So what is important is a stable growth is important. So you kind of need to know your limits, what's based on your psychology, how much time you can spend and how much stress you can take per day or per week. And only in those limits you can trade. So which means you kind of need to make a plan. So okay, today or like every day I'm going to make this much money, and you don't go beyond it. You just do it, you quit. because market is really enticing, and kind of there are so many examples where people actually has lost the entire capital within a few days. So it's a risk. So at the end, what is important is like how much risk you can take per day. What is the risk you're comfortable with when losing? Actually, people say that per day you should not risk more than 2% of your capital, which means if you have a capital of $1,000, you can only risk $20 per day, right? That's the per trade. That is basically the um, the experts say. But again, there's a risk versus reward ratio. Sometimes you risk more in order to gain more, but there should be a hard limit on your risk strategy where you should not go beyond a certain limit when you're actually placing a trade. For example, you cannot go for a trade uh, which gives you like $1,000 profit, but at the same time, there is a potential to lose $500 when your account is only $1,000 capital. I'll explain these more details, practical details, when we come there. Some of the terminologies that you need to understand. I know Forex exchange rate, everybody knows exchange rate. What is exchange rate means? For example, EUR USD. Now, this is actually a currency pair. We'll talk about the currency pair later, but just understand that the exchange rate is always measured in some numbers. For example, here you see EURS USD is 1.3200. That means that one euro is equivalent to 1.3200 US dollars, right? That's simple. Currency is always comes with a pair. You always measure a currency against another currency. So you will not never see EUR. You will always see either EUR USD or EUR JPY, which is Japanese yen, or EUR like Canadian dollars, or CHF, different currencies. Now, PIP is another important Forex terminology that you need to learn. PIP is basically the smallest possible movement in the price in the current market. So the minimum price movement that we can gauge is called PIP. So when you actually do Forex trade, you basically try to get these pips, how many moments you can actually win per day. Based on that, your profit basically determines. Now, I, for example, have $100 in my account, and I'm trading with my $100. Another person, maybe he's having $1,000 in his account. When we trade, if let's say I win 10 pips, he also win 10 pips. I might be getting only $10, but he might be getting $100 for the same 10 pips, right? Because it depends upon how much I am risking out of those $1,000. And based on the risk, we actually get the reward. And the currency, the amount that you actually bid is multiplied by the pips that you earned. That becomes your profit. We'll go into the details, practical details later. Some of these terms, leverage. Now, leverage is a concept where broker has introduced. You don't need too much focus on this one. This is the broker side of things. So in a traditional Forex term, you need to have at least $100,000 in your account for you to trade. But what these brokers are doing is they actually are giving us leverage, which means a 1:100 or 1:500 ratio, which means you still can be able to trade with $1,000. And because they will give you a leverage of 1:100, which means for $1,000, they give you a leverage of $100,000. So you can actually trade up to $100,000 even with your $1,000. So this is a way that the brokers are actually giving you so that you can actually trade and take advantage of the moments in the market. Now, margin is quite important stuff to learn. Margin means it's actually the price, bid and ask price difference. If you see, for example, I don't know if you have ever actually did a currency exchange, but I always do travel a lot, and I always do a foreign currency exchange. So what actually happens is, if, for example, I'm in India and I'm going to US, and I want some US dollars. So I actually take, let's say 50,000 rupees, and or let's say 70,000 rupees, and I ask, the Forex counter, I want to buy like, $1,000, $1,000 worth of currency. So they might ask me like 70,000 rupees for this. So I give 70,000 and they give me $1,000 back. Now let's say by mistake, I thought, okay, now I did a mistake. I don't want US dollars. I want Japanese dollar. I want Canadian dollars. Now I give back to them. Now what I am actually getting in return when they take my USD and then give me my INR is not exactly the same. They will not give exactly 70,000, but they will probably give $60,000, 60,000 rupees, sorry, for $1,000, which means there is a difference of like 10,000 rupees. Now this is called the margin, right? So there's a margin. There's always a margin when the buying price versus selling price. There's always a difference, and that difference is called margin. And that margin is what by which the brokers live. So the brokers actually get the commission by the margin, right? So that's also exactly what we call as a spread. Spread is exactly the same. Okay, I go to the next thing. Going long and going short. So there are two different, basically, two different types of trades we can take in the Forex market, which is if the price of a currency pair is going higher, then we actually go for a buy. That's called going long. But if the price is falling down, then we go for a sell, and that's called going short. So going long is a term that's used by professionals for a buy, right? So you place a buy. You see, the author said, we don't use words buy or sell because buying into a position could mean that you close a trade when you went short or buy. So what he's saying is that professional, they don't use buy or sell, but we, as a common people, when we actually trade, we always use the term buy for going long and sell for going short. Again, I will explain a bit later. So this is actually, I was talking about the margin and the spread. You see, the spread is like ask price versus bid price, right? So the ask price and bid price, the difference is actually called the spread. So when you are basically, for example, when you're trading, when you trade, and let's say you win 9 pips, you will not get the profit of exactly 9 pips, but out of 9 pips, 2 pips, for example, will be kept by your broker. So which means there is a margin that he is keeping, and that's actually called a spread. And that's basically is what he is, the broker is actually taking the commission from. So that's actually called the spread. So as you can see, like on the chart, you always see like sell and buy. It means you can actually take a sell or take a buy, right? So that's the margin. Now, in order for us to basically successfully do the trading, we need to understand the current market situation. That's something called technical analysis. And there are different types of analysis, which I'm not covering in this section today. There's a fundamental analysis, which is mostly based on the sentiment. And there is a technical analysis, which basically talks about how the price is moving and what is the nature of the price movement. Is it moving faster, or does it have a momentum in it, or it has a slow momentum, something like that. And also what kind of patterns the price is moving. All these things we actually observe. And another important thing is bullish and bearish market. Now, bullish means the market is trending higher and higher, which means the price is going high. So in the bullish trend, we actually take a buy. Bearish means market is going lower and lower. So when market goes low, we actually place a sell trade. So we take advantage of the market movement. So what is important, what is the success criteria is that if we are able to predict the market movement, either it is going bearish or bullish, accordingly we place our trade. And if it turns out to be in our favor, if the market moves in our favor, we are in profits. But if market does not move in our favor, then we are in loss. And when actually we have a loss, that's where we get discouraged. But if you have a proper risk management strategy, which means if you plan per day, I'm going to only risk this much, then you would not lose the entire money in a day, but you gradually, lose some, but then you will win another trade. So there's a risk management strategy that you need to take, to strictly follow, so that our capital is preserved, and then we actually can win. And I will actually explain different tips and different patterns when we actually come to the live trading, right? So this is important. And in the risk management, there are some entries like, risk entries, where we do take some risk, and we also, try to do a reduced risk entries. And we also, take about like the momentum. I'm talking about the momentum, which means how fast the price is actually moving, to which direction is moving. All right. So we also consider different time frames. Again, I will explain all these things in the charts when I actually go to the market. So the advantage of the market is, Forex market is a very large market, and there's a lot of liquidity. There's a lot of cash flows moving here and there. So there's an advantage now, but the Forex actually market only works on weekdays, as you know, from Monday to Friday. So there are other markets that are open 24/7, and that does not basically depend upon the economy of the country or of the global economy. And those are the markets which I am targeting to, and that's where actually I will teach you guys. I will try to help you to go to those markets, and then try to explain the different types of strategies that you can actually use to kind of do a winning profits. All right. So as we explained, like the currency pairs, like in a pair, currency is always in a pair. For example, GBP, which is just the pound, Great Britain pound, and versus the USD. So the first currency is always called the base currency, and the next currency is called the quote currency. And you see 1.51, that's the basically index where the price is. All right, so you can read about it a little bit about how the currency basically looks like. So here there are major currencies: USD, Europe, JPY, Euro, JPY, British Pound, Swiss, Canadian dollar, Australian dollar, New Zealand dollar. These are called the major currencies, and usually these currencies are the currencies where most of the people trade. Because they are major one, and there are other currencies as well which are not the major currencies, but for example SGD, for example, let's say CHF is a Mexican dollar, then what else, Indian rupees, and there are a lot of different currencies that are not major currencies, but people still will trade those currencies as well. All right, there are different order types. Again, I will not, as I said, I will not explain all these things because now it's like too much. But just to understand, there are different ways we can enter into the market, right? There's a buy limit, sell limit, and there's a buy stop, sell stop, right? So these are called placing orders. What is important is for you to understand there are two kinds of orders that we can make. One is called current market execution. The other one is a pending orders. Current market execution means you place an order now and that takes effect immediately, right? But pending orders means you basically predict the price movement and to a level, and you will execute if the price reaches to that level, which means you schedule a order. So as soon as price reaches to that level, you trigger the pending order will automatically trigger. And based on your strategy, your like did you take a buy or sell based on the direction of the market? If it is in your favor, you will actually get profits. If you're not, then you will actually lose the trade. All right, so that's why when I say that we need to have a risk management strategy, the first thing in a risk management strategy is the stop loss, right? Stop loss. And stop loss, it's an order connected to a trade. So when you place a trade, what is the risk that you can take for this trade? For example, you have $1,000 account and you predict the market is going up and you place the trade. But when you place the trade, this $1,000 started reducing because you're actually, let's say, market is going against you. Now, the $1,000 became $900. I mean, $1,000 will not go, but you basically, this trade, let's say this trade you place is $100 trade, and this $100 basically started reducing. It goes, you're expecting a profit of 100, but then it went to a negative of 100, and then it goes to the negative of 200, and it goes negative of 300, negative 400, 500, 600, then 900, and then 1,000, which means you waited too long, you stayed too long in this order until it takes all of your capital. So, but this is not accepted. So that's why you take you you take a step where you define, okay, I will not risk more than 2% of my capital, which means I will not lose more than, let's say, $20 or maybe $200. All right. So let's say if you are basically not losing $200, more than $200. So you put a stop loss there. Means you put an entry there where you say if the price, my loss is going beyond 200, the trade will close automatically and I will lose only $200. But if you don't put the stop loss, if the price goes totally against you, then it will probably take all of the money. So risk management strategy number one, always use stop loss. When you are trading, always put a stop loss. There's some other concept called trailing stop loss. For example, let's say you started winning the trade and you're now winning the trade. You got $100 and it's growing $200, $300. Now, if the trade comes all the way, suddenly the price drops and you started going to negative, then you basically lost all your profits. So when you actually put a trailing stop loss, what happens is, let's say you actually win $100 and you decide, okay, if the price goes beyond, it comes down, and then my profit goes from $100 to $50, then I cannot afford going even more down. So you put a trailing stop loss there. And let's say your price, again, your profit grows to $300. Now you decide, okay, now my profit is $300. If the price goes below 200, then I'll close. So you actually move your stop loss. So you're actually moving your stop losses to the place where you're basically now all continuously winning, and you're also managing the risk. Again, all these things we will discuss a bit more details when we actually go to the practical, which I'm planning to show you today a little bit about the charts. Lot size. What is a lot size? So lot size is basically, how much risk, how much you can actually afford. Now we always use like standard lot sizes. I will explain you the lot size in detail later, and how to calculate profit loss, right? So this is a theory. I don't want to go with this one because I'll show you the practical way of understanding this one. What important thing, professional traders, all right, versus non-professional traders. So there's a difference between professional traders and amateur traders. And the reason why initially when you join to the Forex trading like journey, you are actually start from the amateur Forex traders. And then you will actually go. So you cannot become professional in one day. All right. So in order to become a professional traders, there are certain things that you need to learn, right? Which is basically you need to plan risk management, and emotions plays an important role in the market, and it's always the patience that basically controls the emotions. Now emotionally overwhelming is something that amateur forex traders do. The professional traders, they actually purely focus on the technical side. So even the loss, if you lose basically a trade, the professional traders basically go and understand why the trade has been lost, what is the mistake he has done in his strategy. Then he will learn. But the amateur traders, they will go and hunt again and then lose some more money. So that's the major difference between amateur and forex traders. You can read these documents to kind of learn more about it. So technical analysis, this is what I'm talking about. You will never enter a trade without analyzing the chart. The chart tells you, gives you a lot of indications how the price is moving. There is a gradual learning exercise which people learn, which actually gives us basic concepts of understanding the charts. And once we understand the charts, and once we understand the patterns of the charts, then we can predict the market. And then at that moment, we can actually start placing the orders. Again, before even making the technical analysis, you need to basically open a demo account so that you can start understanding the different type of technical analysis. For example, you see this is a currency pair. I don't know if you guys can see. The chart is basically going down, 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 down. So here, as you can see, there's a line that people has drawn. So the price is not going beyond that. Now let me switch to the real charts and show you what actually I mean. Yeah. See, this is a currency pair. Now, I would actually, as I said, I would actually teach you not the Forex currency pairs, but indices. Now, indices are different than Forex currency. Currency is the cash, right? Currency is the cash of the local country. But indices are different. Indices basically are they gauge the market volatility based on the fear. So if the market is if it basically is going down, which means basically the fear is reducing and there are a lot of investments that are happening in the market. But if the price is going, if the chart is going up, which means a lot of people, you guys can see the chart, you're not able to see the chart, right? Jayesh is missed the call. I don't know what happened to Jayesh. Hi, Jayesh. Oh yeah, yeah. I got that point. Let me change it. All right, so I resume sharing. I again start sharing in my desktop and show you this part. So this is the live chart I'm talking about. I will explain you later, how you can enter into, register to a broker and then start, getting your stuff done. But so this is actually how the chart looks like. right? This is the chart. Now the price is, now you see price is making moves. It's actually making, going higher and then lower, higher, lower, higher, lower. Now the indices index actually are called indices. The indices are different than currency pairs. So indices basically they gauge the fear of investors in the market. So based on the fear factor, the price started moving. So if there's a lot of fear in the market, in the investors, then the fear is increasing, so volatility is actually kind of increasing. But if there's a lot of less fear and people are gaining more confidence on the market, then actually it goes down. Now, but you have to understand this thing, volatility 75 or any other indices that I actually mentioned here, they are the simulations, right? So this is a software programmed market. So this is not a real time like market moments, but the software, the programs basically kind of the algorithms that were made, they simulate the situation in the market. So that's why it is not, because it's not the real market. So even if, like, let's say there's a world war or something, or even if there's kind of a news that says there's a war or something, it won't actually affect uh, these trading platforms, because they are not real-time markets, but they are simulated ones. So that's why even if the economy goes down, the market price will still continue according to the program that it is designed to. And because it's a program, not even the broker has the opportunity to kind of go and manipulate things. So it's kind of more kind of stable. So that's why I kind of like to do trade. And most of the Forex traders that I know from my group, basically they all trade this particular pairs. So what I'm actually was talking about, I was talking about the technical analysis. So the technical analysis basically talks about certain things. For example, if you try closely understand this kind of market. So this chart, if you see this chart, right? So it's very kind of you can easily understand. For example, let me draw a rectangle box. So the price, it's funny behaving funny. All right, so the price, if I draw a box here, let me re-log in. So you see this area right there here. So the price always went up and then came down. It went up and came down. It went up, came down. So anytime the price is this particular area, there is a certain moment that price is actually reacting, right? And this kind of analysis that we do, that's called technical analysis. For example, in the terms of the Forex, we call this as a resistance area. So anytime price comes to this area, the price is being rejected and it is going down. So that's why this is called a resistance line. So we kind of try to draw lines on the on this one. So now let me draw this line here. I don't know why I'm unable to draw this. You see, I draw a line here. So now anytime price comes to this kind of area, price is getting rejected. So you see price came here and it came down. It touched here again, it came down. It touched here, it came down. And then so forth. And this area, it came down. So what we're trying to gauge is if price comes to this level, because it has rejected here, there is an opportunity the price will reject here. Again, price will reject here. So if the price comes here, next thing that you do is based on different other criteria, you basically place an order to the sell. And then, so from here to here, you're in profits. So this is called technical analysis. And what I actually showed you is very, very basic stuff. And there are a lot of other things that we need to understand. these candles is under these called candlesticks. They're called Japanese candlesticks. So the price is actually gauged, or price movement is predicted based on the patterns these candles are moving. Now we call this green candle. Green candle means it's going up, and it is called a bullish candle, and it's buy. And anytime price comes down, it's basically a red candle. And when the candle comes down, it's a red candle. That's basically called the bearish candle, right? So price is coming down. And depending upon, so we actually take 2 or 3 candlesticks, understand their patterns to predict the market. So there are different names for different candlesticks. Over the course of few days or few kind of sessions, we will learn more details about this technical analysis. So this is an introduction that I gave you. And the next session, we will actually talk about different types of candlestick patterns and how to identify them. And then we try to draw the lines, and we try to draw the charts, and then we try to predict the price movement. So it's all about predicting the price movement based on the past history, right? People say market always has a memory. You need to also understand why actually it happens, why price comes here and then makes rejection. Why does it happen here? For example, why when price is coming here, it's always getting rejected. Now, you have to understand this Forex market is predominantly dominated by hedge funders. Now, hedge funders are like big banks. They actually, what we're trying to do is we're playing against them, right? And they are the market makers. And these hedge fund banks, they actually influence market than anybody else. So what happens is, let's say every day morning, right, there is a hedge fund trader in a bank that is actually placing a lot of orders here, sell orders. As a result, the market is basically coming down because they actually trade using billions of dollars, and we actually trade only like $1,000 or 2,000. They do trade with billions of dollars. So what happens is, they're placing orders determines how the market moves. Now, based on the patterns, we try, okay, at this moment when price comes here, so the hedge funders are basically placing a trade. As a result, it's actually going down. All right. So now we take the advantage of this moment by understanding the chart. So that's why there are some patterns always happens in this chart. And using those charts patterns, we'll try to figure out. And there are something called the indicators. All right. So here I can add a lot of indicators that basically tells how the price is moving. For example, I can actually add an indicator called bands, Bollinger Bands. So these bands, what actually they tell you is that the price is always within the bands, right? So now price is always going within these bands, which means I can predict. So if the price is basically now going up, it would not go above this band, right? So I can actually take advantage. Now I can place an order buy and say, okay, if it reaches here, then I will exit. So which means from here to here, I actually win. Whatever order I placed based on the number of pips that I order, I'm going to win, right? You observe within 1 minute, the price will come here. And what is the guarantee that price come here? There's no guarantee, but it looks like price will reach here because the indicator says so. So which means how reliable we can depend upon indicators. We cannot rely on different indicators all the time. So that's why there are different indicators. So we don't just use one indicator. You see, now using this indicator, I already predicted the price will reach here. And so the price almost reached here, right? And then made an entry. So which means if I would have actually entered into the market, let me make it bigger. If I would have entered the market here, placed an order, I would have actually reaped my profits here already, because the indicator says, the price will only move between these stuff. You know what I mean, right? So there are indicators which can help us. Now, if you actually go and check YouTube about Forex, there are millions of people that talk about a lot of strategies, a lot of indicators. And I kind of now been working like almost it's 1+ year that I'm actually doing trading, and there are a lot of ups and downs that I've learned from different people. Now, I actually come to some, very interesting journeys where I was able to kind of come to certain level of confidence that by which I kind of now trade. So not every trader will always win. So every good trader, winning guy, will always lose certain trades. So, but the loss is basically a learning, and win is basically is a gain for us. So it's kind of a learning attitude that basically it is. Now, I am going to teach you during these sessions what is the strategy that I follow, what are the indicators, and how reliable they are, and all these things I kind of teach you guys so that you can start trading on the demo account, test account by yourself. You see the price touched this line and then came back down now. So you could have actually took, okay, now price will not go beyond this, so let me take a sell. So you could have taken sell, but then how reliable it is, sometimes it goes against you. That's why we need more than one indicator, uh, and to understand. Now there is one more powerful kind of analysis that is called using your eye as an indicator, which means the more time you try to spend on understanding these patterns based on the foundations that you learn, that's how much your basically eye will catch the predict the next moment. So anybody without even looking at this trade, the expert traders, they can tell you without just looking at these indicators, they can tell you how the price will react, right? For example, I can tell you, the resistance line. I can draw the lines and say, okay, if this price goes beyond and this is a pattern, then price will not come above, price will go below. So these are the techniques that your eye will catch based on your learning. So with this, I kind of now come to the came to the conclusion. As I'm said, like there are patterns that we understand, like different patterns, and I'm going to teach different patterns in the coming days, so that you will be equipped with the knowledge, necessary knowledge for your foundation class. Now I'm actually opening up for you guys for any questions. You can obviously, if you cannot talk, you can chat, you can type any question, and then I will explain you. Any questions, Jayesh? Even if you have no questions, you just type no questions. Okay, Jayesh said, hi, everyone. First of all, sorry for being late. I do have a question regarding the mindset. Yes, please ask Jayesh, what is the question you have regarding the mindset? Jessica has no questions yet. Can you type your question, Jayesh, or you can call me and then ask your question directly over the phone. I repeat, and then I'll explain for the sake of other people. Okay, so Jayesh me to share the PPT on the mindset. This one, right? How? Here's the list of qualities that you need to reach your goals. And what is the question, Jayesh? I'll call you when you're sharing the PPT. Yes. Okay. Call me, Jayesh, then we will talk. I will call you. Are you sure? Yes. Thanks. I'm good. Thanks for the. Okay. So Jayesh said he's good, so he doesn't have any questions. Right. Thanks, guys. So thanks for your time. And then I will schedule another call. Hopefully next week, same time, Sunday, 3 p.m. And then we will talk about the patterns, and we'll talk about how to draw the patterns and how to understand the candlestick patterns and so forth. All right. So thank you very much for joining. I am actually ending this session now. Thank you. Bye.